Good morning, ladies and gentlemen, and welcome to this 12th edition of the Swiss Mining Conference. It's one of the best conferences I attend because it's quality, it's small, it's quaint, and there's a lot of terrific companies, as we'll see. So, it's the third time I'm speaking here. The first time, I can tell you I was pretty depressed. It was November 2015, and I tried to put a good face in front of the audience, and I was so desperate that I said, well, prices are so low, forget about everything, forget about timing, just buy and hold. And it's true that when value is so low, then it doesn't matter if you have to wait, 1 year, 2 year, or 3 year. You always end up making money. And the last conference, and I see a lot of familiar faces, it was March 2016, and my message there was also quite simple. The seniors had gone up a lot, so I said, load the truck on junior gold mines because they have more growth and their valuation were much, much lower than their senior peers. Today, I'm going to try and have also a simple message because I'm from France. I did too many studies in philosophy, this and that, so I tend to complicate things. Of course, now that I live in Switzerland, I try to be a little more pragmatic. So I'm going to try and keep things simple. As a reminder for myself, first of all, I believe we're still in a bull market, so the idea is simple. You buy the dips. We're going to go through a few things. I'll just remind us that gold is always a difficult market. It's always difficult to predict. But all the elements to confirm this bull market seems to be in place. And to my mind, the gold market is intact. Then I'll give you a few ideas on some technical details. And we'll see why this conference is great for stock picking. So the question is, do we have to be obsessed with all these correlations, these smart analysis, or should we just keep it as simple as possible and use common sense? If you look at long-term studies, you can see that there are no correlations that work all the time. The first person to have done very thorough studies on the subject was Amy Gassman, who was the star analyst, the star gold analyst in the 90s. And she showed that long-term, you had very few correlations that would work all the time. So in the 70s, you had oil going up. Every time oil was going up, gold was going up. And then all of a sudden, this beautiful, nice correlation broke down. Same with commodities. With real rates, the correlation is usually better, but you have exceptions also. And for the geopolitics, it's the same thing. We've had a recent example. Everybody thought that, including myself, that if Trump would be elected, then gold would go up. And what happened? Gold went down. So gold is a difficult animal to predict. If we look at, so this I think is a very important chart. It shows you that the inverse correlation between gold and the dollar has been working pretty well for the last 10 years, with correlations in 2011 minus 71, 12 minus 54, 13 minus 59, and so on. So today, people are really obsessed with the link between the dollar and gold. I will tell you that this will not work all the time. So we mustn't be hung up on this small notion. So the question here now is, why is gold down? We've had a very severe correction. In fact, I got that really wrong last time I spoke to you in March. I really thought that now that the bull market was started, that things would be easy. And as we're seeing right now, things are not easy, and we've had just a pretty severe correction. So why is gold down? We always know after the fact, but today it seems that what people are saying is that it's because of risk on, a strong dollar, rising interest rate, and massive hedge fund liquidation. Risk on. So Donald Trump there's a new president, so we have hope. A lot of people believe that it could be a new Reagan, so it's risk on, you buy the stock market. People are a little more skeptic, say, well, even if Trump is not fantastic, or even if he doesn't do all what he is supposed to do or he wants to do because of Congress or this or that, then people think, well, he might have a honeymoon period until, let's say, January when he takes office, or 100 days after January. And these Trump skeptics are also buying the stock market. So the Dow Jones is making new highs. But what I'd like to stress now is that the U.S. today, in 2016, is not the U.S. that Reagan saw when he came into power in 1981. First of all, before Reagan came to power, the dollar had gone down dramatically. The dollar was undervalued. Reagan comes in here in 81. The dollar goes up, and then Reagan figured it was too high, and he pushed the dollar down. So with Reagan, the dollar went up and down. So of course now Trump comes to power. Everybody says, well, maybe the dollar's going to go up, like with Reagan. But the dollar is already up 52% since 2008. So it's a little different. And also, the dollar is up. But the dollar is up against what? The dollar is up against the euro. Do we think the euro is a good currency? It might disappear in a couple of years. It's up against the yen. How good is the yen? It's backed by debt. Rising interest rates. So the question here is that we've had an amazingly long and unbelievably strong bull market in bonds. 34 years of a bull market. We've had interest rates started to go up. What does it mean? Is it predicting a stronger economy? Is this just correcting an amazing excess? Who knows? I tend to believe that we've seen the low in interest rates, and now we're going to have a pretty painful bear market in bonds. Now, is that negative for gold? Not necessarily. Nominal interest rates can go up, and gold can still be up. In the 70s, nominal rates went up something like 15%, and as you all know, we had a fantastic run on gold. There's been a lot of fund selling. The ETF, which had a huge inflow since January, have seen a decrease of 106 tons just recently. Of course, the commitment of trader numbers were very high, so there was a lot of bullishness in the market and a lot of bullish bets. So that had to be unwind. And then you had some famous investors like Stan Druckenmiller saying that he had sold all his gold, which is always a little worrying. Now, should we worry? We have to remember these guys are traders, and they're good traders. They can go in, they can go out. An example, we all know that Soros sold a lot of his gold in the third quarter. He got rid of GLD. What less people know is that on November 15th, he just bought 1.78 million shares of Barrick. So who's going to be right? Soros, who's buying American Barrick, or Stan Druckenmiller? And again, Stan Druckenmiller can change his ideas on a dime. I found a few words from Crispin Odey, one of the great hedge fund managers in London. He's had a bad spell recently, but I'm sure he's going to come back. He's saying, globalization, competition, internationalization are now firmly in retreat. Inflation and protectionism promise a future which is not kind to financial assets as QE and deflation has been. High asset prices now sit uncomfortably with the stated aims of the new thinking. How long can investors cling to the past when faced with new ideas? The new idea, ladies and gentlemen, is a very old idea. It's a bull market in gold. The bull case is still intact. After the bear, the bull. We'll see supply and demand, uncontrollable debt levels, low real interest rates, war on cash, overvalued dollar, geopolitical uncertainty. We've had a terrible bear market. We all remember this. Everybody remembers this. Gold was down 45%, and gold stock were devastated. The seniors were down 82%, intermediates 86%, royalty companies, which are supposed to be the creme of the creme, down 70%, junior producers 94%, developers 94%, explorers 96%. These are not real numbers. These are not indexes. It was computed by Paradigm. So we have to keep it really simple. The stock market, as we all know, is not rocket science. There's a bear market, and after there's a bull market. And these cycles are long cycles. We're impatient. We want things to move. We want to buy. We want to sell. But the reality is cycles take time. We've had a big bear. Now we're in for a big bull. In terms of the euro, the bull market started in 2014. And the last to have turned was the dollar, the gold expressed in dollar, where we saw the low in the fourth quarter of 2015. I wrote a little article for Le Temps in the euphoria of summer, so I figured that gold could well be at 2017 in 2017. I thought it would make a catchy title. Of course, I know I'm going to be wrong, so I'm not worried too much about it. But the trend is up. That's my point. So what is proper investment philosophy? Richard Russell, who was this famous old-timer of the Dow theory, he was always obsessed by the primary trend. If you got the primary trend right, all your investment would work. So the big essential question for Richard Russell was, for the stock market, are we in a bull market or are we in a bear market? Once that question is answered, things are easy. And you can make mistakes in a bull market, you are bailed out of your mistakes. If you're in a bear market and you're long, you're in deep trouble. So, based on common sense, we have to ask ourselves, are we in a bull? Are we in a bear? If we're in a bull market, and if you're all here, I assume most of you believe this, then you buy the dips. This is an example. Unfortunately, I didn't participate in this wonderful bull, but Apple is up 25,000% since its IPO. But there's been devastating corrections. 81 minus 35%, 96 minus 35%, and on and on. But if you buy the dips, even if you don't buy at the bottom of the correction, you do extremely well. Common sense. Good demand fundamentals. Demand is going up. In 2003, the demand was 25 4,200 tons. 2015, 4,200 tons. The uptrend is going on because there's more wealth in middle-class emerging markets. They buy gold. Central banks are buying, they're continuing to buy, and investors in the West are massively gold is massively under-owned in the West. Most banks still have 0% allocation to gold. This means that once fear comes back, they'll be buying gold. Gold production, in my mind, peaked in 2015. Of course, this means that we don't know exactly the numbers, but the output could easily be down 10% in the next couple of years. There are less discoveries, less exploration expenditures, and much, much more regulations. Ask any CEO here the amount of time he's spending with lawyers and things like that. It is terribly complicated, and it's extremely difficult to put a new mine into production, and it takes a lot of time. Debt levels, you know the story. We've had growth for the last 7 years, so you would have expected that there would be a little less debt, and there is much, much more debt. The election of Trump means that you will still have more debt. Why? Because if he gets it his way, you'll have more fiscal stimulus, lower taxes, infrastructure spending, wall building and exercise in Mexico. All this costs money. It'll be debt financed. The trade imbalances in the world are still astronomical. The US has a huge trade deficit with China. It has a huge trade deficit with Europe. So if the dollar was so undervalued, if the dollar had to go up so much, then why is there so much deficit with Europe? The dollar is not a good currency, and it's overvalued. Protectionism also is not a really great thing, and there's also huge imbalance, as you know, in Europe. How can South Europe be competitive with a strong euro? How can Italians or Greek sell their goods? So the euro, could disappear quite easily. There's been a pretty good correlation in the last 10 years between real rates and gold, but real rates are still around zero. That is not a problem for gold to go up in this context. War on cash. So as an example, I'm telling you what's happening in India. You all know that Prime Minister Modi banned the notes, the 500 rupee note and the 1,000 rupee note. Of course, he's doing that for all beautiful things. It's to fight terrorism, it's to fight corruption, it's to fight tax evasion, it's to get inflation under control. But we know these are all scapegoats. The reality is that India is corrupted, the government is corrupted, they're spending 27% of GDP, they're practically bankrupt, so he's playing around. Today in India, gold is up massively. It is tragic what's happening. So the only solution is here. The dollar, I think it's an overvalued hamburger. So you look at the Big Mac index, and you can see that the dollar is overvalued in a lot of Asian currencies. It's overvalued against Japan and many. If you take purchasing power parity, you'll have a similar exercise. Geopolitical uncertainties, I'm not going to go into that. You know the story. There's plenty of uncertainty, and that's good enough for gold to go up a bit. In the 70s, gold corrected nearly 70% before this huge bull run from $100 to $800. We've just had a little correction. It doesn't feel little in your portfolio, but it's a classic Fibonacci 50%. we could be now in a new bear trap. When I was, after I talked in November 2015, I said I was buying a lot of stock here. I felt very bad here because this seems to be a little blip, but that was a pretty big decline. Bear trap, immediately it went back up. Here you have a perfectly perfect, symmetrical head and shoulder pattern. Everybody knows this pattern. It just broke down the neckline, so you could imagine we're going back down to the low at 13. Maybe this is a bear trap again. We'll see in the next couple of days or week if it goes back up. I have the impression that in the Friday, not last, but the one before, 10 days ago, we've had, after the Trump election, 3 days of capitulation with huge volume, and this felt like capitulation. That might have been the bottom of this correction. So here you're in a good spot for stock picking. These are the companies that I suggested buying at my last conference in March here. And as you can see, these stocks went up dramatically. Victoria Gold plus 236%, Teranga plus 174, Almaden plus 162, and so on. Two of the companies that I mentioned that could be takeovers were taken over at substantial premiums. So why is it that here is a good place to go shopping? Well, there are, I think, two main ideas. One is that junior gold stocks outperform. Seniors are big, so it's difficult to grow when you're too big. And most of them are badly managed. They're bureaucracies. Juniors, you have more growth, and valuations are lower. And the second element is that it's difficult to come here. It costs money, there's jet lag. So I would say the better companies have the courage to come here to Geneva. Since the highs in June, we've had a major correction. The index, GDX, is down about 35%. So if we're in a bull market, we should be buying this dip. In gold mines, leverage is back because you've had massive restructuring. Costs are under control. The traumatic bear market is still present in the minds of the CEO, so they won't be doing too many dumb things before a long, long time. And the volatility is so big that a lot of people are going to be very, very reluctant to get in. I mean, after a 35% correction, you don't want to buy gold stocks. You should be buying gold stocks, but it's difficult. This means it's a bull market because it's the wall of worry. So most of the stocks I mentioned last time are still good buys because we've had a nice correction. The most conservative and maybe the most efficient way to buy the dip today is just to buy a good fund which outperforms on the upside. A good example for this is Gold 2000. They were up a stunning 214% since March. They've had a correction now. It's a good time to get back in. For those who want a little more excitement, which doesn't mean it's going to be more profitable, but who knows, here are a few examples of very leveraged propositions. Companies which have a huge deposit, but which are in no way economic today. But if gold is at $1,500 or $2,000, of course, this changes the perception. And preferably no production, because then you don't have production risks. Good example is Nova Gold, which presents here quite often. If gold doubles, it's easy for this stock to go up 10 times or 20 times. Exeter Resource. Here you have a company that has 37.9 million ounces of gold. Yet their market cap is $80 million, and they have $18 million in cash. This means you're paying gold in the ground, ladies and gentlemen, not $200, not $20, $2 an ounce in the ground. In a bull market, this does not last long. On top of that, management is top quality. They have defined a very nice 1.7 million ounce oxide resource with a good PEA that could produce 120,000 ounces within the next 5 years. And their NPV at 5% at $1,300 gold is $250 million. And they're in a good jurisdiction, Chile. Here again, buy the dip. It's down practically 50%. McEwen Mining. We all know that McEwen is a fantastic operator. He created Goldcorp, and now he has his own company. Funnily enough, it's called McEwen Mining. And he owns 25% of the shares. His salary has been increased dramatically. He used to take no salary. Now he takes a $1 salary per year. I like these type of companies. And this stock went from $1 straight to $5 in a matter of 6 months. It can and it will do it again. As usual in a bull market, in a gold bull market, silver outperformed gold. The reason is extremely simple. There is a huge stock of gold. We're talking about 170,000 tons of above ground stock. This means that production per year is 1.6% of that amount. Silver, there is no stock. So as soon as you have demand, you're in a type of a corner, and silver goes exponential. We saw that happen very recently until 2011 when silver hit $50. The silver-gold ratio is very, very high. Silver is very cheap versus gold. The ratio is 70. It could easily go to 50. It could go to 15. A go-to stock is First Majestic. Keith Neumeier is a fantastic promoter. In a bull market, he makes this stock skyrocket. Max Silver, you know this company, it comes here very often. This is Ultimate Quality. They have a joint venture, as you know, with Fresnillo, and a great new discovery. Pan American Silver. This stock, which is a big diversified silver company with a lot of different production sites, could double production. Why? Because they have a fantastic deposit in Argentina. So basically, since the brokers put zero valuation in Argentina because they don't have any permits, the day they will have permit, and with the new president and with Ross Beatty behind, I'm pretty sure that they'll have the permit within a year. So here you have a great silver company plus a free call on Argentina. Not a bad mix. Alexco Resources, one of the cheapest silver mines around. They were a producing mine, but the CEO, when he saw he was not making much money, he decided just to shut down the mine. Why deplete good silver at low prices? He prefers to wait, keep the value for the shareholders. He is renegotiating a deal with Silver Wheaton. Once this is done, the company can go back into production. It takes minimal money to get it back into production. It'll take something like 7 months. And they can produce easily 3 million ounces. On top of that, they've made a new discovery of an amazing area where they have 2 kilos per ton. So this will be an immensely profitable new mine. They have plenty of cash. and they're cash flow positive thanks to an environmental company. Balmoral Resources, market cap $100 million, just their gold discovery could make that a $1 billion market cap. Strategic Metals, low risk project generator. Go for takeovers, Almaden Minerals, they have 5 million ounces in Mexico at $1,400, $1,500 gold. Somebody will take them over. It's an easy triple. Sabina Gold and Silver, you probably remember the fantastic voice of the CEO. He got the stock up. There has been a correction because of some ridiculous permitting issue which will be resolved. The stock will be taken out quite soon. Victoria Gold, fully permitted, good PEA. I expect this thing to be maybe taken out before year end. It could double because the shareholders are really good and they'll not let this company go for a small premium. Orca Gold, high-grade gold discovery, 2 million ounces, North Sudan. The management is terrific. We're talking about the Regback mining team. You can buy this company today at the same price as the famous investor, Ross Beatty. Market cap is only $40 million and they have $20 million in cash. Pretty unbeatable. A few little micro caps just to tell you that it's important to have some money in exploration companies. Today, they're not the flavor of the month, but they're really, really cheap. A few examples. One is here, BC Gold. You have Carlin Gold. It's from the Electrum Group. The market cap is $3 million, but nobody read that there has been a little news release saying that Barrick Gold will be investing $5 million to prove up a nice little discovery. Bravada Gold, $0.2, very cheap. And Cyprium Mining, where if you read a recent news release, there's been a new director, and his name is Peter McGaw. He's the famous geologist from Mag Silver. So here are a few ideas. Thank you very much for your attention. I wish you a really great conference. It's a good time to look at great companies because we should be buying the dip. Thank you very much.
Thank you, Claude.